are stocks? Essentially, a stock is a piece of the company that you own. Companies sell stocks to individuals or groups of people in the form of shares. They do this to raise money for the benefit of the company, whether to fund a new product launch, marketing, expansion, or research and development. Imagine a house as a company. If the owners of the house want new appliances, parts of the house renovated, and/or expanded but need money, they could divide ownership of their house, their company, into smaller pieces and then list them on a stock exchange like the New York Stock Exchange, the NASDAQ, or the Amex. This is called an initial public offering, or IPO. This is the process where a company goes from being owned by a small number of people to being owned by thousands of investors. The company then goes from being a private company to being a public company. This is a very simplified way of looking at it, but bear with me. Now, imagine the thousands of pieces the house is divided into as cinder blocks. One share in a company is represented by one single cinder block that make up the house. Again, the house itself represents one of the many companies that make up just one sector of the stock market. Now imagine the city the house resides in as the stock market itself with only 11 neighborhoods. The neighborhoods in the city represents the 11 different sectors of the economy. The different sectors represent different types of companies that are grouped together because they have similar characteristics such as types of goods they produce, geographical location, size, and so on. A sector of the stock market is made up of many industries. Let's take a look at the 11 sectors, starting with the communication sector. In the communication sector, there's the broadcasting industry, the social media industry, and the satellite industry and internet service providers that enables them to stay on air. The real estate sector includes firms that specialize in renting or leasing hotels, malls, or commercial properties, among others. In the financial sector, there's banking service companies including commercial banks, investment banks, insurance companies, private equity firms, and many more. The energy sector includes companies that produce oil, natural gas, biofuels, solar power, and nuclear energy. In healthcare, there's pharmaceutical and biotechnology firms. The materials sector includes companies that mine and process raw materials such as coal, copper, gold, and steel. The industrial sector includes companies that produce machinery for manufacturing goods such as cars or planes. In the consumer discretionary sector, you have companies that sell products for personal use such as clothing and furniture. On the other hand, the consumer staples sector includes food and household items like groceries and toiletries. These are necessities for everyday life. The utilities sector deals with production and distribution of water, gas, and electricity. And lastly, you have the information technology sector, which is largely dominated by IT companies like Microsoft, Apple, IBM, and Google. Experts advise that you buy stocks in different sectors of the economy. This is called diversification. If a sector of the stock market goes down, a diverse stock investment portfolio ensures that you do not lose all of your money. Going back to the city example, let's say a tornado hits a part of the city and destroys the houses and parts of the communications and consumer staples neighborhoods. If you only hold stocks in these neighborhoods, then you have a high chance of losing all of your money. If, say, you bought stocks in all 11 parts of the city, then you will only lose money in the neighborhoods that were hit by the tornado. This is the power of diversification. You also need a clear understanding of stock price fluctuations. Say a lot of people buy shares in a company. Using our city example, a house with a lot of money pouring into its foundations will be a stronger house compared to the others in the neighborhood. This means more people will want to buy ownership of this house. This causes the price for each individual cinder blocks to rise. The opposite is also true. If the house is starting to fall apart, then the price will go down as not a lot of people will want to be owners. And the more adaptable the company, the more it is able to withstand the forces of the economy. The same is true for houses. Newly built or renovated homes have better value and more potential buyers compared to the older homes that are about to fall apart. Next, let's look at how you buy stocks. There are two routes to go about buying stocks. Number one, a stockbroker. Just like you hire a real estate agent to buy or sell a house for you, A stockbroker will buy and sell stocks for you. What a stockbroker can't do is analyze stocks to find out which ones are the best to buy. This you will have to do yourself. We will teach you how to do this later on this channel, so stay tuned. Number 2, through the internet. Nowadays, you can sign up for accounts online or download apps to help you buy and sell stocks with the help of robots. No human stockbroker needed. Some well-known apps are Webull, Robinhood, Wealthfront, M1 Finances, Acorns, and lastly, Betterment. As a bonus for all my beginners out there, there's an app called Investor that gives you $1 million in fake virtual money upfront to help you learn how to invest. This app has a built-in newsfeed and social media network where you can compete with other users, and if you get to the top of the list for the month, you can win real cash. I will leave links to all of these apps in the description below. What is a stock market index? You may hear people who invest in stocks or on the news say terms such as, oh, the S&P 500, the Dow Jones, or the NASDAQ is up or down by so many points. So what do they mean? In our example, if you only focus on one house to see how well the city is doing overall, you won't get an accurate picture. So what do? You take the highest earning houses from the 11 different neighborhoods and you analyze them separately. Data is gathered from these companies, plugged into formulas, and the resulting numbers are the points for each group. These 3 resulting numbers are what we call indices, or an index if we are just talking about one number. Experts and everyday investors such as yourself can then look at these numbers to see how well the U.S. stock market is doing as a whole. You can then assess how strong your own personal investment portfolio is. So simply put, the S&P 500, the Dow Jones, and the NASDAQ are measuring sticks for the U.S. stock market. Let's look at them as special gym memberships where only the top companies can be members. And each gym has their own committee to select which companies gets to stay on as members, which gets added, and which company gets booted. Let's start with the S&P 500. As the name suggests, the S&P 500 is a collection of the 500 or so largest companies in the stock market. According to Investopedia, to qualify to join the S&P 500, companies must pass some criteria. It must be a U.S.-based company, market cap of at least $14.6 billion or more, have 10% of its shares be publicly traded, have positive earnings in the last 12 months, and lastly, the company must be profitable in the last 3 months. The S&P stands for Standard & Poor's, the name of the company that came up with this index. The S&P 500 is a market capitalization weighted index. Market cap is simply the price of one individual share multiplied by the total number of shares the company has in the stock market. So using our previous example, you take the total number of blocks that make up a house and multiply it by the price of one single block. The Dow Jones Industrial Average, or simply the Dow, currently only has 30 top companies as members on their list. While the criteria to join is almost the same as the S&P 500, the difference is that this gym focuses on the price-weighted average. This simply means that the companies with the higher stock prices have more effect on the total number of points compared to a company with low stock prices but has more shares. Take, for example, 2 different houses. If house A and B are both made up of 100 blocks, but house A sells their cinder blocks at $5 a piece and house B is priced at $10 per block, the performance of company B will have more of an effect on the total number of Dow points compared to company A. Lastly, the NASDAQ Composite consists of 3,000 some different companies that are traded on the NASDAQ exchange and is similar to the S&P 500 in that it is a market capitalization weighted index. But the difference is that the NASDAQ is made up of tech companies and can include non-US companies as well. It is important to note that the NASDAQ is a stock exchange as well as an index, so don't get confused. Taking a step back, we can see that just as you can be a member of 3 different gyms at once, one company can be a part of all 3 of these groups if they meet criteria for all 3 indices. Take, for example, the giant company Apple, which generates so much money it is listed under all 3 indices. But what does it really mean when they say X lost Y amounts of points? Well, when a stock loses 1 point, it means it went down $1. With individual stocks, 1 point means $1. But because indices are collections of high-earning companies, this means 1 point could mean millions and billions of dollars. So a 1 point gain or a 1 point loss means that the companies in the S&P 500, for example, as a whole, lost or gained some amount of dollars ranging in the billions, depending on the economy.